Hey, what's going on? This is my second time trying to make this call here. It was live and people were on this call, but I my Zoom wasn't my audio wasn't working. I kept cutting in and out. So hopefully this works, okay? If it cuts in and out, I guess that you won't see if it cuts in and out. Um, but all right, you know what? Let's just get rid of my face. And this is the first video out of a series of videos that's going to be going over trading plans because I primarily trade smart money, right? And I have an entire course called the Smart Money Boot Camp inside of the Discord. If you go into the educational materials, it is down in there. It is like a 16 video course, and it's a pretty foundational course about smart money. The problem with the course and the feedback that I got from it is it gives you a lot of information. It gives you a lot of components of smart money, but what it does not do is it doesn't show you how to utilize it. And what I'm noticing about everybody, not everybody, but a lot of people is they want strategies. They want step by step strategies that they can follow. Step one, step two, do this, do that. You know what I mean? So that's what I'm trying to do here. And we're going to start simple. I have a couple different trading plans to show you. I have, I believe, 3 to show you today. And there's going to be more videos and they're going to get more complex. I may throw in some more simple ones as we go, but this is what we're doing. So I have some things here that you always need to have in your trading plan if you're going to do any of these trading plans that I am telling you about. So first, you always want to check the higher time frame to highlight points of interest. That's what a point of POI is, and the overall trend and bias. This includes the monthly, the weekly, and the daily time frames, with the most focus on the daily. The daily time frame is so important. I can't stress that enough. Highlight things like the order blocks, fair value gaps, breaks of structure, manipulations, and anything else that you consider a key piece of information. Set up your weekly and daily templates. That is time-based liquidity and key levels. Time-based liquidity is TBL. So what does that mean? What do I mean by time-based liquidity? I mean by like weekly opens, monthly levels also. You could also put monthly levels in here as well. Let me write that in here. You could put monthly, weekly, and daily levels. So you could have monthly opens, you could have monthly highs, monthly lows, weekly highs, weekly lows, daily highs, daily lows. You can even go all the way down into sessions. This one is up to you. You can have sessions highs and lows like New York session highs, New York session lows, London session highs, London session lows, stuff like that. This one right here, you don't necessarily have to, but this is something that I do every single week. It helps me. It helps me identify key levels. Sometimes that's how I identify key levels to look for a stop run and then sell or buy off of that manipulation. Okay. But you definitely always want to check the higher time frame and highlight your points of interest in your overall trend, right? So the first trading plan, this is literally so simple. This is literally just utilizing an order block, the breaker structure, and the impulse, and then playing off of that. This is a simple order flow continuation trading plan using an order block. And I also have one right below it called the simple order flow continuation trading plan using the fair value gap. They are the same thing, just different elements. Okay. So step one, you determine trend. You should have already done that, but I wrote it again so that you do not forget to determine the trend. You can trade counter trend trades, and I even have trading plans for that, but just know that they are very less likely to work. All right. I really hope that my microphone is working, but I do not know if it is. Okay. So you determine the trend, and then you wait for a break of structure or an impulse. You find your order block, and then you set your sell or your buy limit and wait for a retracement. Your stop loss goes under the low of the order block. So if I come over here to trading view, so I can show you this a little bit. All right. So step one is determine the trend. So say we're bullish, right? We'll just say we determined the trend is bullish, right? Say it's going like this, boom, 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 boom. This is the trend. Now say you come to the chart and price is looking like this. You identify a break of structure, you identify an impulse, right? Was that step one? Ah, hold on. I gotta redo that. My bad. Boom, 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 boom. You come to the chart, and this is what it looks like, right? Step one is determine the trend. It is bullish. You wait for a break of structure or an impulse, right? What do we have here? Boom. This was old structure, impulsed through it. So you got step one, which is determine the trend. We are bullish. Step two, wait for a break of structure and impulse. You got that right here. And then step three is what? Find your order block. Okay. Order blocks are almost always down at the bottom of the impulse. Say this is your order block right here. Pretend this is a big candle. Boom, boom. That's your candle. This is your order block. Highlighted order block. And what is the next step? Set your sell or your buy limit. Wait for retracement, and your stop loss goes under the low of the order block. Okay, so next thing is you set your in this case it would be a buy limit. Your buy limit goes at the top. Bullish order block stop loss goes below the low of the order block, the lowest point of this low here. So if there was a wick coming down below this order block here, you would cover that wick with your stop loss. And then take profit would be some other liquidity or fair value gap on the left of your chart. You can pick your take profit. A lot of times you should be managing your trades anyways. A lot of times my trades don't make it to the take profit. I'm partially now on the way. And then the next thing that you would wait for, you really don't have to do anything after this. You got your trend, you got your break structure, and you found your order block, and your order is placed. Then you just wait for the retracement. Normally you want it to come down slowly to it, and then hopefully your trade hits your take. This is trading plan number one, literally impulse, retracement, order block. And then for the very next plan, okay, it is almost the same thing. The only thing that we are changing is the fact that there is a fair value gap instead of an order block. Now, in these ones, there may also be an order block, okay? And this is where I'm going to clear something up for you. So in most cases, the fair value gap is going to be above the order block, okay? But this one, we are strictly using the fair value gap for our entry, right? Just going to draw this order block down here for the sake of representation so that you can kind of understand what I'm looking at here. I'm going to mark the top of this order block right here with a horizontal ray, just so that we know where the top of that order block is. Okay, so you determine the trend. That's step one. You wait for a break of structure and impulse. That's step two. That's what we got right here. You locate your fair value gap right here. And now I have made videos on fair value gaps and how you can enter a fair value gap. You got the top, you got the midpoint, and you got the bottom. Pick one of these 3 points to always enter your fair value gaps in so that you are consistent in the game of probabilities plays. So I always enter at the midpoint. I know that I want to take a buy because we're breaking to the upside. The stop loss still goes below the order block or the low that is below the fair value gap. Okay, why am I still drawing this order block here? Because if price is coming down and then shoots up, there's always going to be a down candle before the up move or a down move before the up move, which isn't. Okay, so this is it. Trend, impulse, retracement to your limit order. Or you don't have to do a limit order. You can just set an alarm and you can enter by market when it gets down here. So this one would look like this. Same thing as the first trading plan. These are very simple. These are basically just order flow continuation trading plan, right? Good stuff. Now, the next one. The next one is the one that actually, no, we got 2 more. Sorry. I forgot about the confirmation entry, which I've already created videos on this before, but I want to incorporate this in here as well. That way, anytime you're looking for a trading plan, if you come to this video and you see the confirmation entry trading plan, at least it's here and you can find it. You know what I mean? Confirmation entry. First, you determine the trend, right? And is bullish. Boom, boom. Let's say it does some stuff like this. Boom, but it's still bullish, still making higher highs, higher lows, right? Boom. We'll just leave it like this, okay? And then you search for a point of interest. This can be an order block. This can be a fair value gap. This can be a breaker block. This can be anything. Whatever you're looking, wherever you see a key level, it could be resistance. It could be any support or resistance line that you decide to make. I personally only like to use order blocks and fair value gaps, breaker blocks, breakaway gaps, volume imbalances, stuff like this, smart money footprints. But for this example, we are going to go with value gap, and we're even going to draw order block just for the sake of representation, just to get you used to seeing it. All right, so we have identified the trend. We have identified our points of interest. All right, at least our first point of interest. And this is why the confirmation entry is used. Okay, you set an alarm once it gets there. So, hey, this price isn't here yet. Okay, you don't set an entry here, right? You see this area and you're like, this may be a good area for a buy, but I'm not sure because we got all of this liquidity down here below that price can get, right? So you're not sure. You don't just want to get in. What you do, set your alarm, and then when price gets to your area, we do not take the trade. We wait. We wait for price to show you a market structure shift in your direction to let you know that your point of interest is valid and that price wants to head in your direction. Okay. You know what? I need to add a step in here. Drop down. Drop down time frames if needed to see market structure. If anybody needs this page with these trading plans on, let me know and I can send these to you. That way you can look at them. Or hopefully you're taking notes right now. That would be even better. It would show effort, your part. Yeah, sometimes once price gets here, right, you have to drop down time frame. So if I'm on the 1 hour right here, you could drop down to the 15-minute. If I'm on the 4 hour time frame right here, I drop down to the 1 hour. Daily down to the 4 hour. 15-minute down to the 5 minute or 1 minute. Stuff like that. Okay. Once you drop down, you look for your market structure shift. Okay. So I have to fix this a little bit. Okay. So to find a market structure shift, you're most likely going to have to go to a lower time frame. But instead of drawing all this all over again, I'm just going to show you what I'm saying. So price gets here, gets to the midpoint of my fair value gap, right? I'm looking for a market structure shift before I do anything. So I'm looking for a violation of the downward trend or the downward correction or the downward retreat. Okay, so what that looks like is something like this. Okay, see, this was moving down, lower lows, lower highs. We made a higher high. Okay, break of structure or a market structure shift right here. Okay, what is the next step? Search for smart money footprints, points of interest, order blocks, fair value gaps inside of your confirmation. Place the limit order on that area. Okay, so after you determine the trend, after you find your point of interest, after you set your alarm, after price gets to your point of interest, you wait for a market structure shift. And then what do? You basically do what we did in this price leg right here. We look for fair value gaps. We look for order blocks. We look for one of your entry criterias to get in now, because what happened here is we've seen the trend. We've seen our point of interest. We've seen, okay, I might want to buy from here, but I'm not sure. Let me wait and let price show me it's going to go in my direction. And then we wait for price to come back, come into our new point of interest, and that's where we enter the trade. Okay, so entry would be right here. Stop loss would be below the new low, this low, not this low. That would make no sense. This also should give you a better risk to reward. And then take profit would be at least the next high. That's already a 3-to-1 risk to reward, but you could be ambitious if you wanted as well. This is the confirmation entry. You need one point of interest. You need it to come into that point of interest, and you need price to show you that it's going to do what you want it to do, and then you get in on the next movement, okay? I also have a complete video on confirmation entries if anybody needs that as well. So now to the last one. Oh, wow. It's not what I wanted to do. All right, so this next one, it's going to be all about increasing your win rate, right? I call this the high win rate strategy. I did learn this from somebody else, but isn't that how we learn? Isn't that how we develop? Okay, so first you got to understand the flow. You got to understand fair value gaps to eternal range liquidity and pro trend. That is the main concepts about this, okay? External range liquidity is just any major highs and lows on higher time frames, or pretty much any high or low, okay? And really all you need is to know how to trade from a fair value gap to a new external range liquidity, okay? We only trade pro trend, okay? And a market maker buy model is incorporated in this as well. That is a 2+ consolidation, then reversal. I'm going to come down here. I've also posted about this as well. This is a market maker buy model. 2 consolidations, consolidation 1, consolidation 2, consolidation 3. And then when you see this, a lot of times the market will run through all of that liquidity. As soon as this trend becomes, somebody's calling me. Gonna have to hold it. Okay, where was I? As soon as this trend becomes obvious, that's when the market makers push through. Okay, they come through and wipe out all of this liquidity. So this market maker buy model and market maker sell model is going to be incorporated in this next trading. Okay. So first you want to identify your external range liquidity. Oh my gosh. Thank you. He's going to have to hold on. Sorry. Sorry about that. I don't know how to pause the Zoom video. Okay. Actually, let me pause this so that I can. All right, sorry about that. Somebody was blowing me up and I had to answer it because they were not going to stop. Okay, so back to the trading plan. The high win rate with the market maker buy model, the market maker sell model. So first you want to identify your external range liquidity and your fair value gap, okay? And this is strictly, I use this strictly with a fair value gap, right? And I have been starting to use this more and more because I've been busy and I can't be staring at charts as much. So I want a more concrete trading plan to help me get into trades so that I'm not getting into bad trades. Okay. So first of all, you do want to understand the trend, right? You want to understand where are we going, right? And then you want to identify your external range liquidity and your fair value gap. And you always want to remember that we are trading from a fair value gap to a new external range. Okay, so if I come over to this, you only want to do this after price has taken external range liquidity to begin with. So first off, you want a fair value gap, which is up here, okay? And then you want external range liquidity, which is an old low. So literally, if I wanted to draw this out and make this even more better for you to see, even more better. That sounds very so it would be something like this. Okay. I mean, forgive my crappy drawing, but an old low over here. Actually, we don't want this low to be lower than that low because this low needs to be this external range liquidity needs to be taken. All right. Just drawing before the video. My bad. So first you need a fair value gap and it needs to sponsor a break through an external range, right? And then once price gets into your fair value gap, you want to come and look at this retracement back up into the fair value gap, okay? And you want to see consolidations. You want to look for a market maker buy model. And I see one consolidation there, one consolidation here, one consolidation here. So what the difference is with this than the other discontinuation models that I shown earlier is there is focus on liquidity here. Okay, so first of all, you need an area of liquidity broken through. If you see that low broken, you come back up here and you look for your fair value gap, right? And then you wait for price to get into your fair value gap, okay? And at whoops, and then at this point, okay, once it gets up into here, we come back and we look at this new low that was set into the market to this high. Let me highlight that. So from this low, which is already highlighted with this external range liquidity, to this high is one price leg. This is one price leg right here. Why? Because this price leg here broke through this low. Okay. Fair value gap at the top, new external range liquidity created at the low after we took out this liquidity. Okay. And now how do we actually enter this? Well, there's multiple different ways that you could enter this, but the easiest way that I'm going to tell you is after you see your fair value gap, after you see that it's sponsored a breakthrough liquidity, and after you see that there is a market maker buy or sell model created, you wait for a market structure shift. Market structure shifts are always going to be incorporated into what it's my confirmation, one of my confirmations to tell me that my trade is going in my desired direction. Now, you could literally just wait for a market structure shift, right? And you could just get in on the shift, right? You could literally just get in on the shift, put your stop above that high, and target this external range liquidity. The next external range liquidity is going to be your target. Why are these not external range liquidity? These are internal range liquidities right here because they are inside of this price leg. This is the lowest low. This is the highest high. This high broke this right here. This low broke this low right here. External, external, internal, internal. That is all stuff that we can go over more in depth later if people have questions about it. But so we are targeting the external range liquidity. This is one way that you can enter. Okay, that is the simplest way, but it's going to be the worst risk to reward. Another way that you can do this is go back and think about the earlier trading plans, right? What are we looking for? We're bearish, determine the trend. Okay. What do we wait for again? An impulse, break of structure, and then we look for our point of interest behind it. So another fair value gap in here. Enter there on the retracement once it comes back up. Stop loss above that. High there. Down to the external range liquidity. We have now turned that 1 to 3 into a 1 to 5.2. Okay. Do want to make a video completely about this specific trading plan right here. If anybody has questions about this specific one, please reach out to me. I will even do one-on-one calls with people to break this one down. It really is simple, really is. But if you don't understand the market maker buy in the market maker sell model, then you may not understand. All right. And do not forget, you need this external range liquidity to be taken first. If this literally just, whoops, can't move that around. But if this, wait, I could, if this would not have broken this, there would have been no reason to start to look for this. All right. You need this first external range liquidity broken. And that's it, guys. That is the first installment of my videos on these trading plans. I will continue this. There will be another one this week. Hope to catch you on the next.